Hey there, fellow investors! Today we're diving into the fascinating world of income statements. Think of it as your financial GPS, guiding you through a company's financial performance over a specific period. Whether you're a seasoned pro or just starting out, understanding this crucial document is key to making smart investment decisions. Now you might be thinking, income statements? Sounds complicated. But trust me, it's not as scary as it seems. It's simply a report card that shows how much money a company made, revenue, and how much it spent, expenses, over a period. It's all laid out in black and white, giving you a clear picture of the company's profitability. Why should you care? Because the income statement reveals a company's financial health. It shows whether the business is making money or losing it. It helps you understand how efficiently the company manages its operations and expenses. And most importantly, it provides valuable clues about its future prospects. So, buckle up and get ready to decode the secrets of income statements. In the next few sections, we'll break down the key components and learn how to spot red flags that could signal trouble ahead. Stay tuned! Let's start with the basics. The income statement kicks off with revenue, the lifeblood of any business. It's the total amount of money a company generates from its primary operations, like selling products or providing services. For Delta Airlines, that's the money they make from flying passengers around the world. But wait, there's more. To generate that revenue, companies incur costs. These are the expenses associated with producing and selling their goods or services. For Delta, this includes fuel costs, salaries for pilots and crew, airport fees, and maintenance expenses. Now here's where it gets interesting. Subtract the cost of revenue from total revenue, and you get the gross profit. This figure tells you how much money the company is making from its core business operations, before accounting for other expenses. Think of it as the raw profit generated by producing and selling those plane tickets. To express gross profit as a percentage of revenue, we use a metric called gross margin. It's a key indicator of a company's pricing power and efficiency. A higher gross margin generally suggests that the company has a competitive advantage, either through lower production costs or premium pricing. In the next section, we'll delve into Delta Airlines' income statement and see how these concepts play out in the real world. Get ready for some exciting insights. Let's take a look at Delta Airlines' income statement and see what we can learn. Don't worry, we'll keep it simple and focus on the key takeaways. As you can see from the income statement, Delta generated a healthy chunk of revenue from its airline operations. Passengers are clearly eager to fly. However, the cost of revenue was also significant, reflecting the high expenses associated with running an airline. Fuel costs, in particular, can be a major drain on profitability. Despite these costs, Delta managed to generate a solid gross profit, indicating that they're effectively managing their core operations. But remember, this is just the first step in our analysis. To get a complete picture of Delta's profitability, we need to consider other expenses, which we'll explore in the next section. Stay tuned to see how operating expenses and other costs impact Delta's bottom line. Now let's move on to operating expenses. These are costs that aren't directly tied to producing goods or services, but are essential for running the business. For Delta, this includes salaries for administrative staff, marketing and advertising expenses, and the costs of maintaining their corporate offices. Subtracting operating expenses from gross profit gives us operating income, a crucial measure of a company's profitability from its core business operations. It shows how much money the company is making after accounting for all the costs associated with running the business. Similar to gross margin, we can express operating income as a percentage of revenue, giving us the operating margin. This metric provides insights into how efficiently a company is managing its operating expenses. A higher operating margin generally indicates better cost control and operational efficiency. Understanding operating expenses is crucial because they can significantly impact a company's profitability. For example, if Delta's marketing expenses skyrocket, or they experience a surge in administrative costs, their operating income could take a hit, even if their revenue remains strong. In the next section, we'll explore the final pieces of the puzzle: interest expenses, taxes, and net income. Get ready to see how these factors influence a company's bottom line. Section 5. The taxman cometh calculating net income. We're in the home stretch now. After accounting for operating expenses, we arrive at income before taxes. This is the company's profit before Uncle Sam comes knocking. Now, every company has to pay its fair share of taxes. This includes federal, state, and sometimes even international taxes, depending on where the company operates. Subtracting income taxes from income before taxes, we finally arrive at net income, the holy grail of the income statement. Net income, also known as the bottom line, represents the company's total profit after all expenses and taxes have been accounted for. It's the money that the company can either reinvest back into the business for growth or distribute to shareholders as dividends. Analyzing net income is crucial for investors because it shows how much profit the company is actually generating after all costs are considered. It's the ultimate measure of a company's financial performance. But remember, a single income statement only provides a snapshot in time. To get a comprehensive understanding of a company's financial health, we need to look at historical data and identify trends, which we'll explore in the next section. Section 6. The power of the rear-view mirror, tracking trends. Analyzing a single income statement is like looking at a single frame in a movie. It doesn't tell the whole story. To truly understand a company's financial performance, we need to look at historical data and identify trends. Think of it like this. If a company's revenue has been growing steadily for the past 5 years, that's a positive sign. It suggests that the company is gaining market share and expanding its customer base. Conversely, if revenue has been declining, it could be a red flag, indicating potential problems with the company's products, services, or overall market position. Similarly, tracking trends in gross profit, operating income, and net income can provide valuable insights into a company's profitability and efficiency. Are margins expanding or contracting? Are expenses growing faster than revenue? These are all critical questions that can be answered by analyzing historical income statements. In the next section, we'll compare Delta Airlines' financial trends with those of Uber and Google, highlighting the importance of industry context when analyzing financial statements. Get ready for some fascinating comparisons. Section 7. Delta versus Uber versus Google, a tale of 3 businesses. Now that we understand the importance of historical data, let's compare Delta Airlines' financial trends with those of 2 other companies, Uber and Google. As you can see from the graph, these 3 companies have vastly different financial profiles. Delta, being a mature airline, has experienced relatively stable revenue growth, while Uber, a younger company in the ride-hailing industry, has seen explosive growth in recent years. Google, on the other hand, has consistently grown its revenue at an impressive pace, driven by its dominant position in online advertising. Looking at net income, we see a similar story. Delta's net income has fluctuated over the years, reflecting the cyclical nature of the airline industry, while Uber has yet to turn a consistent profit. Google, on the other hand, has consistently generated strong net income, thanks to its highly profitable business model. This comparison highlights the importance of industry context when analyzing financial statements. What might be considered a red flag for one industry could be perfectly normal for another. Always consider the company's competitive landscape and overall market conditions when evaluating its financial performance. In the next section, we'll discuss some common red flags that investors should watch for in income statements, regardless of the industry. Spotting warning signs in income statements. Watch for declining revenue and shrinking margins. Declining revenue signals weakening demand or increased competition. Shrinking margins indicate rising costs or inability to raise prices. Ballooning expenses suggest poor cost control. Be wary of unusual items or one-time gains. Always conduct thorough research and analyze multiple years of data. Section 9. Keep learning, keep investing. Your journey to financial freedom. Congratulations! You've now completed a crash course on income statements and learned how to identify key metrics, analyze trends, and spot potential red flags. Remember, this is just the beginning of your journey to financial literacy. Next, delve into balance sheets, which provide a snapshot of a company's assets, liabilities, and equity at a specific point in time. By combining insights from both income statements and balance sheets, you'll gain a comprehensive understanding of a company's financial health and be well equipped to make informed investment decisions. Remember, investing is a marathon, not a sprint. Keep learning, stay curious, and never stop asking questions. With dedication and a thirst for knowledge, you'll be well on your way to achieving your financial goals. Now go out there and make some money.